theory is to derive a conclusion about prices or returns, right? We express prices usually in the level of returns or expected returns. Right? So far we have now looked at what investors would like to do, but we haven't said anything about the return, where the expected returns come from. So this theory was an extension of the Markowitz theory. Markowitz developed this in '52. And then there were three authors kind of working in parallel on this, 62, 65, and 66. The last one, Jan Mossen, is usually forgotten, so if you ever write a paper, please mention all authors. Especially because I actually wrote my dissertation in the spirit of Jan Mossen's approach. So basically the idea is that you can write down the model in different versions. They all come to the same conclusion. So you can write everything on the level of returns, and Mossen did everything on the level of cash flows. Right? It's kind of the same derivation, but it's just a different approach to do this. And back in the day, there was no internet, so the interactions between researchers, so Mossen is a European researcher, so and Sharp was in the US, so the interactions are kind of were pretty limited at that time, so you couldn't just Google if someone else was working on it, basically. So you already see here, if you look at the list of assumptions, that there are some assumptions on there which should look familiar. The first three assumptions are very much the same as you should have seen from portfolio theory. Right, so these are this here, same as portfolio theory. So the consequence is that in this world, in this model world here, everything, and all the findings that we derive for portfolio theory will still hold. But unfortunately, this is not enough, so we have to add a new assumption. And this is this equilibrium assumption. So this is new or additional to the portfolio theory. So this is an assumption that Markowitz did not require for his derivation. Right? For theorists, that's always kind of the thing that they're interested in, kind of what is the minimum set of assumptions I need to make to derive a result. Well, you can add 20 more, and you would probably still get the same result, but which of the 20 additional assumptions is really necessary? Right? There's even a word for this in research, it's called parsimony. So a parsimonious model is a model that has the least parameters, the least variables to explain something. And for theorists, that's always desirable. So a parsimonious model is the one with the least explanatory factors, and that's considered to be the best model to explain something. The simpler the model is to explain an effect, the better, basically. Right? Which is actually quite refreshing if you think about that people tend to make everything complicated, and actually the opposite is true, right? The simplest model is the best one. So it turns out we need one additional assumption, and that is equilibrium, that you hopefully have seen already in some economics classes. It just basically means supply equals demand. Now, if you think about this, what would be the consequences if the market is really in equilibrium, right? If supply really was equal to demand, right? If my demand is satisfied in that sense, that means that I have my optimal portfolio already. So what would be my consequences? That I would just like to keep that portfolio. So I have no incentive to go to the market and trade. Right? So if everyone holds their optimal portfolio, that would be the consequences for equilibrium. There shouldn't be any trading, right? Because people already have what they want, so why would they change that? Right? And now go to the stock market and see what's happening there every day. There's lots of trading. Right? Of course, there's also new information arriving, so people rethink their decisions. But just the mere fact that you see so much trading, for me, is an indicator that people don't really know whether they have the optimal portfolio. They want to change it, right? So that's why they trade. So this is an assumption that's pretty fishy, right? Because we see that people are changing their portfolios every day. And by the way, not everyone's having the same portfolio, right? That was a prediction from portfolio theory that everyone wants the tangency portfolio. But many different investors, professional investors even, have different portfolios. So how can they all claim that's the tangency portfolio? Only one of them can be true, right? So again, something that is highly doubtful that the market is indeed in equilibrium. Right? That's a very strict thing. Like, tell me a market where you could really say that supply equals exactly demand. Right? So I think this is, like among the assumptions that you can make, this is probably the strictest one and the most difficult one. Right? So there are different pricing models out there. There are pricing models that only relate, for example, rely on arbitrage. Right? So if you compare that, the market is an arbitrage versus the market is arbitrage free versus the market is in equilibrium. I would say it's much more likely that the market is arbitrage free. And we already had some criticism about that, right? But equilibrium is really, really a difficult concept. And I would say this is the toughest assumption that we'll make throughout the class. But unfortunately, it's required to derive a conclusion here. So it doesn't work without this condition. So that will be our premise here, that in addition to everything we had discussed before, demand has to equal supply. So we already talked about demand. So demand here is what investors want to have. And in terms of risky portfolios, we have already discussed that they want to have the tangency portfolio. Right? That was our outcome of the portfolio theory. Now, what is supply? Supply is basically everything that you could buy. Right? So all the securities which are out there, which are issued by corporations, that's not limited to stocks only. That could be bonds, could be, you can buy real estate if you want, you can buy gold, like everything where you can put your money in basically. That's supply. And this will be kind of a little bit of a challenge later on when we want to test the model empirically, because we can't really observe the prices for everything that we could potentially buy because markets are not liquid. Right? So people often kind of take the focus here too narrow and say it's only the stock market. But that's not what the spirit of this is. So we call this portfolio the market portfolio. And that is the portfolio of everything that you could buy, everything where you can invest your money. This will be important later on because in this chapter we will kind of put the betas into play. And we've already thought about how do we compute the beta? Well, it was the returns of a stock in comparison to the returns of an index, right? So the index was kind of, at that point, something that we could freely choose. It was just our indicator for how the economy was doing. This theory here is much more strict, so we need to compute betas with respect to this, to the market portfolio. And you can very easily argue that, for example, in Germany, people often take the DAX stock index. Right? The DAX has 40 stocks in it. Is that the market? Well, probably not, right? It's just 40 stocks, right? So you're missing out small stocks. You're missing out other asset classes, right? So if people using this model use the DAX as the market portfolio as an indicator for that, that's definitely a big mistake. Right? So here we have a very strict kind of focus on what this portfolio to which we have to compute the betas, what that portfolio should be. Right. So the point that it should be value-weighted is not really important, but it just means that the more you can buy of something, the higher the return should be weighted in the computation of that. Right, I will show you some kind of things that people are using in practice. For the US, there is a very nice free source of data. So there are two empirical researchers, Kenneth French and Eugene Farmer. Farmer has been the first empirical researcher to receive the Nobel Prize. And he co-authored lots of papers with Kenneth French. And Kenneth French has a free website where he puts all the data online. You can download it for free. We're actually going to do that in the week before the break. And we're going to apply these information. So he has data for what he believes is a good approximation to the market portfolio. So basically he uses the portfolio of all the stocks that you can buy, but it's only stocks. Right? So it's the so-called CRSP value-weighted portfolio, and CRSP is an abbreviation of the database, CRSP. It's the Chicago Research Center for Security Prices or something like that. So Farmer teaches at the University of Chicago, that's why. Okay, so tangency portfolio's demand, and the supply will be the market portfolio. Suppose we can kind of observe that in this theory. Now, when supply equals demand, those two portfolios should just simply be the same, right? Now, how does this work now technically? So technically this works basically in the way that people kind of observe a set of prices and form their tangency portfolio based on that. And then we check, is this the same as the market portfolio? Well, if not, then we have to change the prices of everything that's in the market portfolio. And then people redo their optimization here, and then we check again. All right, so it's kind of, you can think of this as an iterative process, or something that quickly happens, right? So there's no time delay between it. Yeah. So maybe one hint on, because we're going to discuss derivatives later in class, the financial products which are created by kind of people meeting in the market and agreeing kind of to exchange cash flows. Derivatives are not part of the market portfolio, technically speaking. The reason for this is that they don't naturally exist. Like stocks do naturally exist, right? There is a positive supply of stocks. For derivatives, that's not true. They're in so-called zero net supply. So they're created by one person selling it and one person buying it. So there's always, for every long position, there is one short position. Right? And that's why they're not part of the market portfolio. Basically, if you kind of aggregate everything up, all the long and short positions cancel each other out. Right? So there's no positive supply in derivatives. That's why they're not kind of part of that. Still, you can apply the theory to price derivatives. I'll show you what the consequence is. It's actually a pretty remarkable consequence. And another kind of hint that the model might not be true in reality. That's the next chapter, basically. We're going to test this, and I'm going to show you lots of evidence regarding this. Right. I'm very critical towards the model. Nevertheless, I do research about it. I've kind of written kind of derivations or extensions of the model in theory, and I'm testing it empirically. And the reason for this is kind of twofold. First of all, it's a consistent theory that has a logical reasoning behind it. And kind of every theory that you will meet has the same kind of logic behind it. So in that sense, it's kind of a beautiful theory if you want to use that word. And the second is it's the most applied theory in finance. Like if you go to a corporation and people kind of think about how to determine their cost of capital, that's the model they're going to use. Right? Hopefully they're aware that it has some flaws, and I will show you maybe some ways to get around these flaws and kind of maybe adjust a little bit. And that's what certainly some people in the industry are doing, right? But most people are relying on this theory. Right? So that's why it's important to know how the theory works, such that you can apply it in the job context. But you should also know the criticisms, right? And it should raise some red flags maybe in some instances. So let me give you an example of how this kind of price adjustment here works, right? So it's like a little bit easy to say that it's just the invisible hand of the market doing everything.